Let's bring on board then a view from Schroders. We've got with us Virginie Misonov, and she's the Global Equities Fund Manager at Schroders. She joins us from London. Virgin, hi. Firstly, after the recent sell-off, do you see value in emerging equities, or it's developed markets only which will outperform according to you in the second half?
I think in the second half we're going to find a base in emerging markets, and we should clearly start to look at accumulating them, but it has to be very, very stock by stock specific. So what is difficult to say at this point, given the diversification and the diversity within emerging market, is that all the asset class will do better. Instead, I think we're going to have some patches of outperformance, and we should start to do some bottom fishing, but very, very carefully.
Virginie, so within the developed market space, are you bullish on Europe or US?
Okay, so again for us it's bottom-up stock picking, and we find some really attractive companies across both continents, if you want. In our global mandates, we are overweight Europe and underweight the US. The size of the US in the benchmark makes that there's so much opportunities across the world, and there are parts of the sectors in the US that we don't really like. So we maintain an overweight to Europe and an underweight to the US, despite a positive top-down view, if you want, on the US.
So there has been much debate recently about hot money flows out of Asia. We've recently seen these reflected in currency corrections. What, according to you, does this mean for equities?
Well, I think the whole flow out of emerging Asia is really linked to this process of normalization of monetary policy around the world. And you really started to see that when Bernanke started talking about tapering. It is very interesting to see that in his last speech, he's warned the market that this was not going to be, an absolute rapid move, in the sense that he's still quite cautious about the economy, and he wants to make sure that he doesn't strangle by going too fast. So my personal view is that he's planted the seed. The market has helped him do his job in terms of normalization by bringing, treasury rates up. Within that, people who were invested in emerging market debts in Asia have thought that with normalization of yields, potentially in the US, they would be better taking some of that EMD allocated money and putting it back in other markets around the world. That is what has started to create the pressure. Because we do not see a very sharp tapering, or, if you want, withdrawal from QE in the US, nor a very sharp and sudden interest rate increase in the US, but rather a slow normalization over the next couple of years, I think that a lot of the pressure on emerging Asia might subside in the short term, and therefore those markets might do a little bit better.
So when do you expect quantitative easing tapering to start, by 2013 end or only in 2014?
I think that, clearly by planting the seed in the market, Bernanke has had the market do part of the normalization, as we discussed, with US yields starting to increase. In terms of clearly withdrawing QE from the $85 billion a month, I think it's going to be really dependent on what we see in the data over the next 6 months in the US and how the second half plays off. As we know, there's still some weakness in the US economy. We've just had the Detroit city story, for example, and there's a lot of good things happening in the US, but there are still some tensions. So I think that there's a fine line between keeping QE too long or taking it back too early, and he's going to play it, as he says, by how the data goes. So I think we have some mild discussions between now and year end, potentially with some gradual reduction, but definitely more in 2014 if the economy continues to improve.
So do concerns on growth slowdown in China and India worry you?
Well, I think China and India are actually two very separate cases. If you take the case of China, we've had a cyclical improvement, if you want, from October last year. And since then, we've had the new team that was being put in place with Li Keqiang and Xi Jinping. And they are really now working on to their strategy. They've been officially, if you want, put at the economic seat of the country in March, and they are formulating their strategy. Now, their strategy is not only an economic strategy, it's also a fiscal strategy and a reform program that is very important in terms of creating a base from which China can evolve and grow over the next 10 to 15 years, given its current development. Because it's quite a massive kind of work to look at all those reforms, they've taken their time, and I think that by October this year we'll have more formulation of what they want to do. In the meantime, the market has been very worried about growth. I'm personally in the camp that says that growth in 2013 will be between 7 and 8%, and it's fine. We do know, however, that over the next 5 years, Chinese economic growth, given its ongoing maturation process, will probably slow. But given the size of China as the second largest economy in the world and the need to transform itself towards more of a service and consumption-driven economy, I'm really fine with that. With regards to India, the factors are a little bit different. Clearly, we have elections happening next year. We also have a sensitivity of the economy to oil prices, for example. That's because of the large import level of oils. And the need for reforms in the market, and clearly more recently support of the currency. So I think it's a much longer structural reform and at another stage of development of the Indian economy. And I am hopeful that over the next 5 years, India will show some very strong growth prospects. But over the next 12 months, it might be a little bit timid, if you want.
Virginie, appreciate your time and thank you for your insights.